Hey, it's Dave. We got some inflation data today. The CPI, which is the consumer price index for the month of May, came in right at expectations, which is low at 0.1% month over month, and that brings our total for the year, the average for the year, at 4.0 for inflation. Remember that the Fed's target right now is 2% inflation. So we're still above that, but we have started to lap some of the higher interest or the higher inflation reads from last year. We were going up against a 0.9 from last May, and then June was a 1.2. So more than 2% in just those 2 months last year. And so now we're down at an average of 4, but we're knocking away those big ones. And I'll show you that in a little bit. We had the market react pretty favorably today, and the Fed is meeting tomorrow to decide what they're going to do with interest rates. The market is now predicting a 90% chance that they will hold rates as they are, pausing. They've come out and basically said, expect a pause, but just because we pause now doesn't mean we're not going to raise rates later. They've kind of warned the market that because they pause for this particular meeting, that doesn't mean that they're done raising interest rates. So we're expecting no change tomorrow. Looking at what mortgage rates are doing, we're still kind of at that 7% range. I've said before, you'll probably get 6.5% if you shop around with a broker, if you've got good credit, down payment, that kind of stuff. And so, rates are still high, but house prices are holding in there. Let's take a look at the inflation report. You've seen me do this chart in the past. We need to make sure that you understand that this May is what we're not looking at anymore. That's as of last year. And so we're looking at this section here. And the new one that we had is a 0.1 for this time around. So you could see those two big ones that I was telling you about that are going to be lapped. We just knocked off the 0.9, and then next month we'll knock off the 0.2, and then it gets a little tougher to go up against these numbers. You're probably not going to see a lot of excitement around inflation after next month's read, because these are going to be harder numbers to really change what the overall inflation is, because we're finally getting away from the big peaks that we had last year. So if you want to look forward to that, if you just count these, we're at 2.9%. So if we continue at this like 0.1 trend, maybe even a 0.4, you're probably looking at a low threes, like a 3.0 to a 3.4. Is what the reads are probably going to be going forward through the summer. It won't be until we get to like September, October, where we can maybe take a look at those coming in lower, that we might actually get into the twos. But this is not all good news, because there's a segment that I've been avoiding talking about that is the core CPI, which takes out food and energy. And the reason I don't like to talk about it is because my major expenses and your major expenses, if you go through your bank statements or your credit card statements, is food and energy. And so they like to track that because food and energy have a tendency to spike and be volatile and be a little independent of monetary policy. So you saw that with egg prices earlier this year, when you have an avian flu go through and wipe out a bunch of the chickens, then the price of eggs goes to like $8 a dozen. It's now back to like a little over $1 a dozen, $1.50 a dozen, something like that. Oil has a tendency to do that. Heating oil for the winter time has a tendency to spike, then it comes back down in the summer. If the Gulf is active with hurricanes or big storms, you'll see them shut rigs down and stuff, and that'll affect oil prices. So they don't want to use that in calculating they want to separate that out when they talk about the core inflation. And that's things like housing, like transportation, like medical services, transportation, I think I said that, but like vacationing, travel, all of that kind of stuff is in the core. And that's proving to be a little more problematic. So the blue line here is what the regular CPI data is that I've been showing you, where we kind of hit even 9%, and then we've been really aggressively coming down since May of last year. And so now we're down at the 4. This is the 4 line here. But you could see the core, which is the black line with the circles. This is CPI minus food and energy. And it's kind of hovered around the 6.5, and it's only come down to 5.3, still way, way higher than what they want. So that's going to be problematic for the future hikes that the Fed might need to do. I think they're going to take a pause and see how the current amount of interest rate hikes has affected the core. It might take some time for the data to catch up with this stuff. As we said, food and energy is more volatile. It'll come down faster. This stuff is being a little bit stubborn, and you can see it's barely really come down from a year ago, from 6 to 5.3. So that's not something that is looking exciting for the prospects of no future rate hikes. That's probably something they're going to want to take a closer look at moving forward. I wanted to highlight a couple of things in here, actually really just one, and that has to do with rent. We talked about this in a previous, I'll take you off of that so you don't get so dizzy, but in a previous video, I talked about how their data is very lagging when it comes to housing data. And I've got different sources where I can pull data, at least for rents. Rent.com and a few other websites post things that show you how rents are performing. And then when you compare that with the rental data that they have on the CPI, it's way out of line. You're looking at 8% is what I saw for shelter. Is the overall number here, 8%. And then if you look at rent, 8.1, rent of a primary residence, 8.7. That's the number that they're looking at, which is way out of whack. If I pull up Redfin data, this is an article they just posted recently, you'll see that rents obviously came up over the pandemic, but they peaked here. This looks like about August of 22. If you go back a year to May of 22, rents were at 2006, the median price for rent. And then now at May, we're actually slightly below that. You can call that flat if you want. It's just barely below. So they're definitely late on the data that they're getting, if you want to believe Redfin's data and some of the other companies that put this information out. So I believe Redfin has accurate current data. I believe that Zillow does. They're in apartments.com and a lot of these other ones, that they're taking the data in real time and publishing them monthly. But I don't know what the Fed's using, but it's not accurate. It's not an 8 when you compare it to everything else. And I think that's kind of why they're going to take a pause on the rate hikes and kind of wait and see if more data comes in that shows that information is going to help lower the core CPI. That housing and services and shelter is like 35% of the weighting of the CPI. And so it is a big number that's going to help bring that core CPI down. So that's what I've got for you today. Inflation looking good overall. A pause is expected for tomorrow. Interest rates are still high. Housing prices are still holding in there depending on what market you're in. Boise, Austin, not doing so hot. Miami, Milwaukee, Wisconsin are positive at all-time highs. And the overall housing market is hovering around like a 3% drop this year versus last year. Not a crash, just kind of a cooling down. Volume is way down. But things are looking good for a pause tomorrow, and we'll see what mortgage interest rates do over the summer and what the Fed does moving forward as we kind of normalize inflation under 4% We'll have to see how things go after that. Thanks a lot for watching. Like and subscribe if you want to stay updated on this type of information. Thanks a lot for watching and have a good day.